Morning. You're listening to Insurance Matchmaking, your path to health, life, and Medicare coverage with Matt Libby Insurance. And now, sharing his knowledge, here's your host, Matt Libby.
Welcome back to another episode of Insurance Matchmaking. I know I always say good morning, and the intro always says good morning. And sometimes I know if you're listening to this later on YouTube or something like that, it might not be morning. So I'm going to start trying to remember to say welcome back. And that way it doesn't matter what time you're listening, because I don't know, I'm funny like that. When I do something, somebody says good morning, I was like, well, it's 3 o'clock. So anyway, couple things I wanted to just touch back on. I had mentioned recently, I was talking about different life insurance policies, and I could not remember off the top of my head. One of those things I should roll right off my tongue is an MEC, or a Modified Endowment Contract, and that happens with the permanent life plans because they do build cash value, and the monthly premium is not. You're not limited to only putting that money onto your insurance policy. So you can actually boost the growth of that permanent life policy. And it's especially index universal life plans, generally the premium for those are set at the minimum amount to keep those policies in effect. Because what they do, they work very similar to a whole life plan, but they do have that tendency after, like 20 years or 25 years, they'll start eating into the cash value to pay the insurance costs, and so that cash value can diminish. So if you're looking to build a nest egg for retirement, an IUL is it's not that it's a bad tool, but it might not be a good tool if you're only paying that minimum monthly premium. So that being said, it's kind of like we just bought a new camper, and unfortunately I had to do payments on it. So we weren't in a position to just pay cash for it. I don't like to have debt, but this time it was kind of a hurried thing. But generally I've done this before with cars, is paying more than the monthly premium. Anytime you have a loan, and I'm not a financial person, I'm not a banker, but it's just kind of general knowledge that, if you pay extra, you're actually reducing the principal, because most of the time on a vehicle loan, you're paying mostly interest when you first buy it. And the same thing actually with your home too. So anytime on those kind of loans, if you can pay a little extra, you'll reduce how long you're paying for it, because you're reducing the principal of the loan, which is what the interest is being charged to. So kind of the opposite with a permanent life plan. The more money you put into it, the more the interest compounds and you build more cash value. The problem is if you try to put too much money in it, then you turn it into an investment vehicle, as they call it. And that's why I have to caution myself is, as an insurance agent, we're not supposed to say getting a whole life policy is an investment. It can build cash value, it can add to your savings, but we can't call it an investment. It kind of works like one, but we can't call it that. And that's why they have what they call with the Modified Endowment Contract is if you overfund your life insurance policy, it does become an investment vehicle. Now, obviously, I would never try to sell it that way, and I don't have a securities license, so I wouldn't try to sell it that way. But some of them you can even double what your minimum premium is. But if you're like tripling it, or, maybe it's $1,000 a year. Just use some round numbers. That's what your premium is, and you get some money somewhere. You got $5,000. Oh, I want to put that into my life insurance policy. That'll really boost the cash value. Well, that would probably be over, and then it would become a modified endowment contract. And what happens there? Now you have tax issues, because with a life insurance policy, it's tax free to your beneficiaries. The issue is, if it turns into a modified endowment contract and you're earning interest on basically the government, IRS, the government is looking at that's investment income. So you can pay more to build more cash value, but there's limits on it. And you usually should get a letter from an insurance company saying you can contribute this much per month or per year to your insurance policy, and it will not be a MEC. So just wanted to clarify that. And I know I may not be explaining it perfectly, but it just bugged me last week or a week before when I said, and I could not think of Modified Endowment Contract. So I was able to get that title and say, oh, yeah, that's what I was trying to talk about. The other thing was, and what reminded me, I got sat in on a webinar training yesterday about different types of policies. Sometimes business owners will insure their employees because if that key employee, something happened to them and they passed away, it would really hurt the business because they're the ones actually running the company. You're just the owner, or they're your top person, and you're going to have to start doing their work on top of yours, and your business is going to suffer. So you can have a life insurance policy that kind of help cushion that, and also maybe provide a little extra funds for hiring, temporary employees or something like that, doing some of the other things that key person did until you find that right person to replace them. So that's one of the reasons, that business owners will get what we call a key man policy. And then there's also buy-sell agreements. If you have a partner, and it's not your spouse, not your romantic partner, just a business partner, that maybe you share 50-50 in the business, or 60-40, partnerships all have different investment levels. But the issue is, again, you two are the business. And if one of you passes away, there's half of the business not being worked, and the spouse of that partner may not have the money to buy out, or the surviving partner won't have the money to buy out the surviving spouse of that partner. So you can get a buy-sell agreement, and you have life insurance on each other. And usually those are whole life policies. And again, so you have to be careful how much you're funding those, because you don't want to have a modified endowment contract. The other is, one of the key things on this training I went to yesterday was what they call insurable interest. You can't just go out and buy life insurance on your neighbor. It's like, hey, that guy is really risky. I know something's going to happen to him in the next 2 years. I'm going to insure him, and then I can cash that in. You're not allowed to do that. You have to have an insurable interest. It needs to be a relative, an employee, a business partner. And I'm not going to go into all what constitutes insurable interest. And actually, the trainer summed it up really well. And the way it works is why it needs to generally be. It needs to be a relative, and aunts and uncles and nieces and nephews generally can't. If you're a guardian, say you have custody of your sister's kids, and now you are their guardian. Now you have an insurable interest, and you can get life insurance on those children. But generally, aunts and uncles can't purchase for their nieces and nephews. Grandparents can, but that aunt and uncle relationship usually does not qualify for insurable interest. But again, you can always look into it. Possibility, again, if you're involved in raising that, you're showing that you are in that guardianship, and so you could have an insurable interest, even though that's a typical relationship that doesn't come into play. And the trainer summed it up that your interest has to be more in that person's life than on their dying. So if you're mainly insuring them because, hey, I know I'll get insurance payout when they die, that's not the reason to get life insurance. And so, like I said, the reason for buying the insurance you need to have more interest in that person's life than in gaining from their life insurance. So that's kind of how they look at the insurable interest. And I know I didn't say it quite the way the person said. I probably go back and think about how that said it. It just, I hadn't heard it put that way before. It's like, oh, that makes sense. That you can't have more interest in insuring them than in their life. So that's why it's usually close relatives, or spouses. So that's pretty much. I went into more in life insurance than I meant to today, but those couple things came up yesterday. I was like, oh, I need to touch on those. The other thing, and I don't know if this will take the whole show or just may take this segment, and I'll have to speak on something else after the break, but I had mentioned that there was going to be some changes coming when it comes to the Affordable Care Act, ACA marketplace, also known as Obamacare, and I was very right on that, which, I think everybody kind of knew it was going to happen. We did get an email this week of a proposed rule from CMS. It's not the final decision, but it's pretty likely that what was laid out in this new rule this week will be the so-called law of the land. And one of those that we were definitely expecting was the enrollment period. The open enrollment is going to go back to ending on December 15th, not having that additional month to January 15th for a February 1st effective date. So it's going to be important to make sure that any enrollment or re-enrollment is accomplished before December 15th. And I know, and we'll talk more about this later. It's kind of early, but since this came up, I wanted to update on some of the changes that are happening and try to explain them in a way that, because there'll be things come out. I've seen some things in some of my insurance groups already on Facebook hitting on some of these issues, and of course sometimes they go a little extreme and Chicken Little, the sky is falling. There are some changes that are happening, and I kind of wish some of them weren't happening, but I do understand also why they are happening. So I will kind of get in. I'll probably do a little more explaining on that after the break. I still have a couple minutes on this segment, but I don't want to start something and then finish it. One of the other things that will probably, I'm almost positive will transpire, and that is the removal of the ongoing 150% of the poverty level special enrollment period. And I've explained it a couple times, I think, on a couple previous shows. Just to reiterate, is you have to have the minimum income of the federal poverty level to get the subsidies on the marketplace plans, because it's called an advanced premium tax credit, which reduces your premium because it's subsidizing it. So the subsidy is based on your income, and you have to have some income, and it has to be a minimum income. Right now, for a single person, that's around $15,000, just to keep things simple. So what's going to happen there is, right now, if you were, and I didn't do the math on it, but if you earned up to 150% of that amount, so say you earned $20,000 a year, you're still under 100. So the $15,000 is 100% of the poverty level. $20,000 is still under the 150%. So you had an ongoing special enrollment period that you could enroll in a plan. And then one of the reasons they're changing that is because, again, people would wait until they got sick to get insurance instead of getting it when they were without insurance. So the current administration figures that we want people to get insurance when they're eligible, not wait until they absolutely last minute till they need it. So this will will help some of the costs on the insurance. So we're at the break, and I'll touch back a little bit more on that after the break, and then talk about some of the other changes.
Are you ready to stream the big games this March? Stay connected with a gig speed fiber connection from Tri-Lite. Fiber is the best way to connect, delivering the speed and reliability you need for every game and everything else you do online. Plus, new customers can receive $15 off per month for the first 2 years of service. That's a savings of $380. Order today by calling 833-847-0824 or visit trilite.net to learn more. Offer valid for new residential customers only. Terms and conditions apply.
Need a little help with home repairs? The Habitat for Humanity Critical Repair Program is here to lend a hand. We're accepting applications now through February 14th for non-emergency repairs like plumbing, roofing, and more. Visit uchabitat.org and click the Critical Repairs Program tab to apply, or stop by our office at 1546 East Spring Street, Suite B. Don't wait. Applications must be postmarked by February 14th. Habitat for Humanity, helping you make your home a better place. Equal opportunity provider. Discrimination is prohibited by federal law.
And now, back to Insurance Matchmaking with Matt Libby Insurance.
All right, we're back. And I was talking just before the break about the 150% special enrollment period that we do have now. As far as I know, it's going to be good until open enrollment. They haven't said that they're going to stop it. I mean, they could. I believe it would just be a rule change. And so that rule could be implemented prior to open enrollment. So right now we do still have that 150% special enrollment period. So if you know somebody who's been doing without insurance, but they do work, they do have a small income, but you're concerned about them having insurance, have them give us a call. We still are getting people new policies now, and we're in the middle of March right now. So as long as we do something before the end March, it will take effect on April 1st. And that also applies to the Medicare Advantage plans. We are still in the open enrollment period. So if you found out that your doctor is not taking your Medicare Advantage plan, give us a call. We'll see if maybe another plan might be a better fit for you. And we can get that done for April 1st being the effective date. So you still have a little time on that if you haven't taken advantage of that. So just wanted to touch on that the first quarter of the year is generally a good time to review any plans you have, because otherwise, if you don't do it now, you may have to wait until the open enrollment period next fall and not be able to not have a change take effect until January 1st. So just make sure you get with this if you think maybe there may be a change you need to make. One of the other changes with the ACA is you're going to have to provide more proof for things. Provide proof that you are losing coverage from a qualified health plan, or that your income, if there's no tax documentation from filing income tax in the last couple of years, and then you just throw a number out there or say to get a low monthly premium, you're going to have to come up with a little bit more proof on that. The other, I guess there probably was an issue. We didn't do it in our office, but a lot of times, as I mentioned, you have to have that minimum income to qualify for the tax credit. That you could have people that aren't making that, but they're saying they're going to, and so they apply, they get the tax credit, they get the insurance for the year, they file their income tax, and they made $10,000. They didn't qualify for the minimum income. The government has not gone and after those people and come back and go, oh, you got tax credit for your insurance, but you didn't make enough money to get that tax credit, so we have to take it back because you don't have it. There's no money to take back from them because they don't have it. So they generally don't go after that. Now, if you underestimated your income, and it is going to be reflected on your income tax. So that's a very important thing to make sure you do. Along those lines, just kind of a reminder, we had a client call in yesterday, found out that client got married back in November. Well, they've been doing their insurance and getting a tax subsidy based on their income as a single person. And when they go to file their income taxes, they will have to, and you have to file married filing jointly. You can't, if you're filing married, you can't file separate and get the tax credit. So either way, that individual's going to probably have some tax issues because your tax subsidy changes when you have a spouse and now you have combined income. And if that spouse earns more than you, or you could have been eligible to be on your spouse's employer plan and it was affordable. Those, again, are reasons that the government can say you didn't qualify for that tax credit you received. And if it's $300 a month, $400 or $500 a month tax credit you're receiving, that's a lot to have to pay back on your income tax. So if you get married, and or get divorced, those are major life changes that you do need to update your marketplace plan on those. Now, Medicare clients, not really going to make a big difference other than if you fell into that where you have what they call the IRMA. We've talked about that a couple times. If you're paying extra for your Part B and now you're divorced or your spouse has passed away, we need to look at your income and see what that might transpire, because you may end up having more surcharge or having the surcharge now because the higher income was yours, but now you're single. So those are things to keep an eye on. One of the other changes on the marketplace, and we will be getting with our clients to remind them, is probably a little bit more of what I usually do with the Medicare people. We always try to get a hold of all our Medicare clients in the fall before the enrollment period to update all their information. Who's their doctor? What are their prescriptions? And those are the two main things we need with Medicare folks, because those are the things that are going to affect what policies they have, whether they have a Medicare Advantage, and if it makes sense to switch that plan for the following year, or what drug plan they have. This year was quite an upheaval with drug coverage, and we expect a lot of change this coming year because there was, as I mentioned before, those supports put in to keep the drug plan premiums down, and there's going to be changes. Just trust me. There's going to be a lot of changes when it comes to the drug coverage and Medicare Advantage plans this fall. So we're definitely going to need to do a lot of review on that. This year, I think we're going to have to do a lot more review on our ACA clients, because one of the big things that's probably going to change is the tax credits. There was more, they were increased under the Biden rescue plan, the COVID rescue plan. It was like the first big piece of legislation in the Biden administration, and those benefits sunset. They were not permanent benefits. They are due to expire at the end of this year. So we will go back to the previous subsidy levels, which the government doesn't have to do anything, and they will go back to the pre-2021 levels. What's going to happen there is not so the increase on the tax credit is not going to affect people that much. Yes, everybody's going to be paying a little bit more for their health insurance because they're going to get a little bit less tax credit. The ones it's going to affect are the ones in the higher income scale. Previously, the eligibility for the tax credit was capped at 400%. And the example I always use, and I just keep numbers simple, a couple in their 60s, because that's who it usually happens to. They're getting close to retirement, but they don't have an employer plan, or they decide to go ahead and leave their employer and start their own business. But they're figuring they're starting to draw. They can draw some of their IRA or 401k money out because they're older than 59 and a half, and they're increasing, and that goes towards their income. But it also is, that's now taxable. But what happens is, if you estimated your income at $65,000 and got a very sizable tax credit, so your insurance was very affordable, and you're thinking, well, I need another $10,000 out. I need to have this pay for a new roof on the house, or I want to make a good down payment on my new truck, not have as much loan to repay, and so you take an extra $10,000 out of your retirement funds. Well, now you're at $75,000 for your income because you took that extra $10,000 out, and at $70,000, and this is for example purposes only, but at $70,000, you hit that 400% mark on your income. You're not eligible for tax credit, and it doesn't happen when you hit that increased income. It's based on the whole year. So you estimated your income was $65,000, and say you're getting $1,100 advanced premium tax credit to subsidize your marketplace plan for you and your spouse, and then you file your income tax and you earn $75,000, and so when you went over that $70,000 threshold, I call it falling off the cliff, because you're no longer eligible for a tax subsidy, so you're going to have to pay back that $1,100 a month, times 12. So you're looking at, over $10,000. You're looking at probably about $13,000 that you owe on your income tax. So it's very imperative that you review your income and estimate it, and then determine if a marketplace plan is the right option for you, because that tax credit can be, remember, that tax credit you're not getting is going to add a lot to your bill. There are alternatives out there. We still don't have word on whether the short-term plans, we're going to have that 3-year lock-in on the underwriting for those. I do expect that to come out in the next few months. Like I said, I mentioned on a previous show, I'm probably going to add MediShare to my offerings just for people who decide, yes, I'm going to have to spend more than I'm spending right now on my marketplace plan, but once I'm not eligible for the tax credit, it's going to be half as much as I was paying. So we want to make sure that we can take care of everybody and protect you against those unforeseen medical expenses, and we'll have some options there for you. The other change, it's kind of weird. Again, talked about those that maybe shouldn't be getting the tax credit because they're not earning enough, or they're just not reporting it well, or they were just, it'll automatically renew your plan that you're on. based on your income level that you had estimated. The new rule is going to kind of push people more to don't just passively renew. I've in the past I've said that, oh yeah, you're fine, you like your plan. Was there any major change to your income? No. Okay, yeah, you don't have to do anything, it'll automatically re-enroll you. The marketplace, the rule, CMS, and I'm saying not the marketplace, CMS is saying they want everybody to review their income and make sure that it matches what their tax records say. Because a lot of people were qualifying for a zero premium plan, and what they're saying is they're going to charge a $5 premium if you didn't update your income until you update your income and justify that, yes, you are getting a zero premium. If the case is still the case that you still qualify for a zero premium, they will refund that $5 premium that you're paying. Or if your tax credit or your premium is going up more than that $5, that because you are earning more, that $5 that you have paid will be credited to your premium. So it's not really a penalty. It's just more of an incentive to make sure that you're updating your records to justify. So it's just a $5 fee to make sure until you update your record. So reason I bring that up is we are going to be probably reaching out a little more aggressively to our under 65 clients to review those plans. And it's really simple, actually, because we send out links, we got forms filled, and the main thing is we just need an update on the income, basically. It's real easy for us to go through and just update your application, and then we can email you the option, say, hey, this is the plan you have. And a lot of times those plans change, and the plan you have is not going to be the best plan for the next year, or sometimes company drops that plan, and they usually have one that what we say crosswalking you to. So we try to make sure that you're going in the plan that you want to be in. So we're going to probably have a lot more face-to-face, or not necessarily face-to-face, but one-on-one meetings with our existing clients to make sure that they're on the right plan. And it doesn't take long. You can fill out that form. We have 2 forms that we have to have you sign. One is to give us consent to review your marketplace plan, and the other is to get the info we need to make sure that we have all the info to do an estimate on your plan. And we can send you those quotes, and we have a link we send you. You can go ahead and complete the application from there, or you can say, oh, yes, my income's going to be this, and if it's okay to keep the same plan I have, I'd like to. And we can just whip that through. It's just, it takes like 5 minutes to go through the application and update it. Now, one of the changes they made last year is we do need a verification from you that you agree to that plan, and we usually can just send that to you in a text or an email, and you just log in and look at it and go, yep, I agree, and it's done. And that came about because we had a lot of people going and changing people's plans, and they didn't know about it, and they never talk to the person. And so they just kind of added a little extra level of security to make sure that you are appointing us as your agent, and we have reviewed your options with you, and you like those options. So it looks like I'm out of time. Till next week, remember, Matt Libby Insurance, we can cover you from head to toe. It doesn't have to cost you an arm and a leg. And be sure and go to insurancematchmaking.com to review my past shows, and we'll talk next week.
You've been listening to Insurance Matchmaking with Matt Libby, your path to health, life, and Medicare coverage with Matt Libby Insurance.